All right, welcome back. We're going to be getting into section 351. Show you what that is all about. So, section 351. So no recognition of gain or loss. And this is transferring property either from a new from an old corporation to a new corporation or individually to a corporation partnership. So the requirements, you must transfer property, cash, assets, things like that, must be solely in exchange for stock, and transfers must be in control of the corporation. So control is recognized by 80% of the stock, basically, either non-preferred, either voting, you gotta have 80% control. So the rationale is that the transfers have not changed their situations economically, so they should not be taxed. They owned it before, they own it afterwards, it's just in a different entity type. So shareholder takes a carryover basis from the property to the stock, meaning adjusted basis, or use an alternative calculation, take the fair market value of the property, either less deferred gain or add back your deferred loss. But we're going to be getting into quite a few examples here. So here we've got A and B. They are forming a new company. A contributes $100 in cash. So they had $100 in cash. They're changing it for the stock. Their basis in the stock is $100. B has they're contributing the fair market value of land valued at $100. Their adjusted basis is $20. So new company's carryover basis is $20. Right? They get B's carryover basis. Because these two are in control more than 80%, there's no recognized gain or loss. So here we've got services. So services, I kind of wish this slide was later, but services are not considered property. So that doesn't count towards your 80% total control. So here, A is contributing property with a fair market value of 60,000. Their adjusted basis is 15. So A's basis in the new stock is 60,000 because they're recognizing a $45,000 gain because B is contributing services, right? So the control here is 60% because A is contributing property, B is contributing services. Services don't count. Therefore, A would have to recognize the 45,000 gain. If B had contributed property worth 40,000, then they would meet the 80% control requirement. A would not recognize 45,000 gain, but their adjusted basis in the stock would be 15,000. Because they're recognizing this gain of 45, their basis is it's confusing, but there's a lot of examples that we're going to do, so hopefully I'll clear it up. But because B contributed property or services and not property, they don't meet the 80% requirement. So section 368 definition of control is 80% of total combined voting power of all classes of voting stock, and it's got to be both, 80% of the total number of shares of all other classes of stock, such as non-voting preferred stock. Note, you must meet the 80% threshold for each class of stock, not just non-voting preferred as a whole. So you got to have 80% of each class in order to qualify for approval. So here we've got a services transaction similar to the one we had before, but it makes sense after we kind of go over the control requirement. So A is contributing property with a fair market value of 80,000, adjusted basis of 15. They're getting 80% of the stock. B is contributing 20% of services. So A meets the 80% requirement. So A does not have a built-in gain. So they don't have to recognize the 65,000. Their basis is lower to 15 because they're not recognizing it. If they did recognize the gain, this was 79 and 21, then A would have to recognize that 65,000, but their basis would be the 8,000 that they contribute because they're recognizing it. Here, this kind of goes into what I was just talking about. So A contributes property with fair market value of 70 and adjusted basis 15. And that's for 70% of the stock. B is only contributing services. Services does not qualify as property, so they're not in control of the 80% requirement. So 80% control requirement is not met. A must recognize the gain of 55,000. So that's the fair market value less the adjusted basis, built with gains. But A now has a higher adjusted basis. So here we've got a property and services, and the rules for that are a little bit different. If you contribute both, then the services, the property has to be at least 10% of the total. So here we've got A contributing property, with fair market value of 70 and adjusted basis 15, and they're getting 70% of the stock. B is contributing services of 25, fair market value of property is 5,000 and the adjusted basis is 2. So B is going to recognize income from the services. That's one thing I probably should have hit on here. You recognize if you're contributing services for stock, you recognize that gain. If you're contributing property, you don't necessarily if you qualify for Section 50. But if you're contributing services, you recognize it. So going back to this problem, B contributes services worth 25, property worth 5, and adjusted basis of 2. So B is going to recognize the 25,000, and they're going to have the carryover basis of 27. The services provided 25, and the adjusted basis of 2. Here, the 80% control requirement is met since the fair market value of B's property contribution is over 10% of the value of the services. And that's, I can't contribute $1 of property and $50,000 worth of services and get this treatment. This is to kind of circumvent that, so they say it's got to be 10%. So since fair market value B's property contribution is over 10% of the value of services, here we've got the value of services 25,000 times 10%, 2.5. The fair market value is 5. That's over, so we're good. So here we would meet the requirement. Even though it looks similar to this one, but who cares? B also contributes property. There's a slightly different calculation involved with it, but they clear the 80% threshold. So here we've got another one. Prior to contribution, A and B's holding new company stock is worth 50,000 each, and they each own 50 shares of the new company stock. So A contributes fair market value 20,000 with 3,000 adjusted basis in exchange for 5% additional, and B just contributes cash. So 351 is satisfied because B contributes additional property with at least 10%. So the 50,000 times 10% is 5,000 of the current holdings. A can defer recognizing their gain. So the 20,000 of the fair market value less the adjusted basis because they clear the 80% threshold. So disproportionate exchanges. So here, Dad contributes fair market value property of 75,000, adjusted basis 30 for 50 shares. The son contributes cash of 25 for 50 shares. Those are different amounts. So Dad may owe gift taxes on the extra 25 shares transferred to son. Really, he should have 75 shares and his son should have 25, but he's gifting 25 shares. Right? The dad contributed more, son contributed less, but they have equal amount of shares, each 50. So the son would be getting a gift. So section 351 is met, so dad can defer the $45,000 gain, right? That's the 75 less the 30. Dad is deemed to have made a gift of 25 shares to son. So dad's adjusted basis in his 50 shares is 20,000. That's the 50 shares divided by the 75,000 times the 30 adjusted basis. And the son's adjusted basis is 35. The 25,000 he contributed plus the gift from his dad. So effective section 351 on transfers. issues. Is there a realized gain or loss? Is there a recognized gain or loss? What is the character of the recognized gain or loss? What's the carryover basis? And what is the holding period? These can all kind of differ, but generally you're not going to recognize a gain or loss because it's section 351, it's a non-taxable exchange. You will have a realized gain or loss, but you just defer. Okay, here we're going to get into boot. Trying to think of an easy way to describe boot to you. If I contribute $100,000 of property or 80,000 of stock, and the company kicks me back 20,000 to make me whole, right? I contributed 100,000, I only got 80,000 stock. They say, okay, here's 20,000 cash to you to make up the difference. The 20,000 would be recognized. That's boot. You recognize boot. So what is boot? It's cash, it's notes, it's property, it's securities, stock in another company. It is not stock in the transferee company. That would be stock. Boot is basically anything outside of stock in the transferee company. So computing the shareholder basis, so the basis in the boot is the transfer's basis, that's the fair market value. Generally, you can see it as cash received as boot. There can be other things, there can be note receivables, but it's generally cash. So your basis in the new company stock is the adjusted basis transferred to the new company plus the gain recognized, less your fair market value of the boot, less the cash boot received. These should be kind of the same thing. Less the liabilities assumed by a new company. If I transfer a liability, that's kind of recognized as boot. And that is your just basis of stock received. So here we've got an allocation of gain. So fair market value of equipment and land is 100,000, 30 for equipment, 70 for land. Percent of the fair market value, 30, 70, right? The adjusted basis is 20,000 in equipment and 20,000 in land. So your realized gain is 10,000 for equipment, right? 30 less the 20. And for the land, it's 50, it's 70 less the 20. And they received 50,000 and 50 shares in new company stock. So here we've got the allocated boot of 1535. That makes up our 50. And we've got the gain recognized at 1035. So our carryover basis in the company is 40,000 plus 45 plus 50 equals 35,000. So effective section 351 to transferees, is there a realized gain or loss? Is there a recognized gain or loss? What's the character? What's the carryover basis? What is the holding period? It's kind of the flip side of the transferors, but so effective section 351 to transferees, the transfer of new company stock or debt issued by new company in exchange for services, property, cash equals no realized or recognized gain or loss. So new companies transfer property to a new shareholder, gain is recognized as sold, and losses are not recognized. So you don't want to sell a loss, you don't want to transfer a lost property to a corporation because you don't get to recognize that. So effective section 351 to transferees, basis in the property received. So transferor's adjusted basis and property being transferred to the new company. You got to recognize the gain recognized by the transferor, less any reduction for lost property. That's new company's basis. And we got some examples here. So Bob transfers to new company a piece of land with a fair market value of 20,000, adjusted basis of 2,000 in exchange for 100% of new company stock. Bob has owned the land for 2 years. So since 351 applies, right? He's getting at least 80%. Exceeding 100%, it's at least 80. The new company will take an adjusted basis in the land of 2,000 and will have the same holding period as Bob, right? It's a carryover basis. Example 2, Bob transfers to new company a piece of land with fair market value of 20 and adjusted basis of 2 in exchange for 50% of new company stock, so less than 80. Bob's owned the land for 2 years. So 351 does not apply. Bob recognizes the 18,000 in gain, and new company will take an adjusted basis in the land of 20,000. Right? Bob has now recognized the gain, so that's new company's basis because it's been recognized. It wasn't deferred. So effective section 351 to transferees, receipt of lost property. If a shareholder transfers lost properties to a corporation, then the basis of the properties must be reduced to fair market value. Prevents a double deduction, one at the shareholder level at the high basis and a high basis at the corporate level if there was no deduction. Right, so you got to recognize reduction in basis and is allocated in proportion to the built-in losses on a shareholder by shareholder basis. So if the adjusted basis is not reduced to fair market value, then your holding period will tag. If the total of fair market value of assets is greater than the adjusted basis, then you don't need to recognize a reduction, right? Because it's greater. And if shareholders elect, the shareholders can take a reduction in basis instead of the corporation. So this kind of gets into inside-outside basis. I'm not going to get too deep into that because the book doesn't really, but people can have differing levels of basis. The company's basis could be different than my basis in that asset. So assumption of transferors liabilities. So transfers not under like-kind exchange rules, section 1031. If I trade a building for a building, that could be recognized under 1031. It's a non-taxable exchange. The assumption of shareholders' indebtedness by new company is not the equivalent to received cash. Assumption of liability is in essence treated as a return of capital and reduces the transferor's adjusted basis. So you're not recognizing the boot in the liability for the transferor, but it does reduce the adjusted basis. So you can use this treatment as long as there was a proper business purpose for the debt. You can't do it just to offload liabilities. And the liabilities assumed are not greater than the adjusted basis of the property transfer. So if the liabilities is greater than the basis, then the transferor must recognize the excess liability as right. They offloaded this liability that was in excess of the adjusted basis. They've got to recognize it. Transferor has zero basis in his or her new company step. Calculating transferor's basis, assuming that new company assumes transferor's liabilities, basis in the transferred asset, right? So this is encumbered by some debt, this asset that's being transferred. The basis is the cash transferred plus the gain recognized. So that's the liability of the basis. That's the transferor's basis in the new company stock. So here we've got an example, section 118. So Stonebriar Incorporated wants Robbie's Sporting Goods to locate its new mall that is developing in Denton. It offers Robbie a tract of land in the mall site upon which the sporting goods store can be built. The fair market value of the land is $1 million, and their adjusted basis is $100,000. Robbie does not have to recognize the $1 million in income, but he's got to take a basis of 0 in the land. And that's because the fair market value was $1 million, the adjusted basis is $100,000. So Robbie gets 0. I'm just going to go through these quick. These slides won't take long. So worthless securities, we kind of covered this before in a separate chapter. You recognize a worthless security in the year that it's declared worthless, and it would be on the year end, so 12/30. Examples of ordinary loss situations, securities that are non-capital, stock in affiliated corporations, section 1244 stock, and worthless unsecured debt. So if it's non-business, that's a short-term capital loss, right? If I loan someone $1,000 and they never pay me back, that would be a short-term capital loss. And business debts can be ordinary losses. Ordinary losses, so NOLs, can be carried forward indefinitely, starting in 2018, but you can only take 80% of the taxable income. I can't knock my taxable income down to 0 with an NOL. but I could knock it down to 80% of that. Tax planning considerations. So 351 is automatic. It's not elective. So if you meet the requirements for it, you automatically enter into it. You might not want to automatically enter it. So you might want to bust that, by not receiving at least 80%. Maybe you want a higher adjusted basis. If we go back here, so maybe in this situation, Abe wants to recognize that 55,000. Maybe he wants a higher basis here. Whereas here, his adjusted basis is the 15 because he met 351. Maybe he wants a higher basis. Maybe he's thinking that that asset is really going to appreciate in that partnership corporation, and he wants a higher basis associated with it, and he's willing to recognize the gain into it. Lost property should be disposed of before any 351 transaction, so losses get recognized, but there's a lost property with 351. You can also avoid section 351 by busting the 80% requirement. Taxpayer may have a reason for carrying a high basis in the assets. However, section 267 may prevent loss recognition anyways if shareholder owns less or greater than 50%. 267 deals with I'm blanking on the term. Arm's length transactions. Yeah, I gotta go back to the book. Related party. I should have been able to think of that. I don't know why I could. So related party is section 267. You're kind of getting into arm's length transactions there. But if it's a related party, there's certain differences for it. All right, and that makes up chapter 2 for corporations, partnerships. Like I said, 351 is kind of a big part of it. It's important to understand how 351 works. You've got the transfer of property, selling in exchange for stock, transfers must be in control of the corporation immediately after the exchange. I'd say look through some of these examples, make sure they make sense to you as to why they would or would not qualify for 351. Yeah, and that is it for this week. At least, well, for this chapter anyways. And I will post videos for chapter 3 after this. All right, thanks everyone.